friends, thank you and welcome back. Let's continue with the same session that is regarding tax return, right? Employment section number 4 of 1003, if you remember. So we are going to continue with the same session where we were going through the tax return. Like we saw different schedules and new schedules and some summary pages of tax returns. Now we are going to see, or we are going to review each schedule one by one. But before getting into the schedule 1 or schedule C or schedule D or schedule E, I have a couple of things that I wanted to share with you. What are those? Number one, how do we identify? My question is, how do we get to know whether a borrower is self-employed? So first of all, that is 1003 Uniform Residential Loan Application. In the loan application, at the section number 4, employment section, in that section there is a small checkbox. In that checkbox there that checkbox signifies that if it is checked, that means borrower is self-employed. I mean, borrower has a self-employment. If that is checked, that is how the first we can easily get to know that yes, borrower is a self-employed, and we are going to consider or calculate income according to all the guidelines need to be applied according to self-employment, right? Self-employment borrower or self-employed borrower. Okay, then there is if borrower that checkbox is not marked. What are different scenarios where we how can we determine that borrower is self-employed? So it could be like a commission income. Whenever we receive a borrower pay stubs, and we can if we calculate income, we verify income that borrower is receiving more than what is the total income, monthly income or total annual income. If borrower is receiving more than 25% of his earnings from commission, then we can we need to apply the self-employment guideline in that rule. What is self-employment guideline? Mostly it is either 1 year or 2 years of tax return that need to be requested from the borrower side. That is the mostly. It could be like for VA, it could be 1 year tax return. For FHA and conventional, it could be 2 years. But please go through your FNME or Freddie Mac guidelines before applying or before asking those tax returns. Okay, so that is generally how things or guidelines apply in the commission. So I mean to say, whenever borrower has more than 25% of income from commission, he or she will be treated as self-employment or self-employed borrower as well. Okay. Now next, in this case, commission, whenever borrower is receiving, they might not check on this, or they might not mark this checkbox. So this could be, the updated 1003 that we are going to prepare. We can mark this checkbox for borrower because borrower is receiving more than 25% of income from the commission. And whenever we are going to update the LOS, that is loan operating system, right? Whenever we are going to update the LOS, there we need to we need to select borrower income as a commission income. Otherwise, what will happen? Whatever the AUS findings we are going to run, that is not going to recognize whether this is a commission income or this is a basic income or regular income, right? So make sure whenever we are going to run the DU or LP according to the our investor, whatever AUS we are running, before that we need to make sure our LOS system, LOS means loan operating system, that system is has been updated according to the income that should be like, it should be updated as a commission income. Then only AUS is going to recognize its commission income and commission total. It is going to apply, calculate if the commission income is more than 25% of total income of borrower, then AUS is going to throw the conditions, going to through the conditions that need to be applied. Mostly that is for the tax returns, right? Okay. Now, if borrower haven't provided any pay stub in any case, and they are giving us 1099 miscellaneous for the income, we will get to know that borrower is a self-employed. They are not direct employee of the company, but they are working as a 1099 miscellaneous employee, or as a third party vendors. In that case, they are going to give us 1099. We will get to know that this is borrower's business income, and again we are going to we can update LOS accordingly, and we are going to ask them for a tax returns. I mean, we can identify they are self-employed borrowers. Now, there is one more, and the tax returns. Whenever borrower is self-employed, we are going to ask for the tax returns 2 year or 1 year of tax return. That is going to, that will depend on the product, will depend on the mortgage type, what type of mortgage we have applied. Remember mortgage types: FHA, VA, right, conventional, USDA. So we need to check their AUS, we need to check their guidelines, and whatever they are, if we are allowed to ask only for 1 year, we are going to ask for 1 year. If that guideline says or ask us to request 2 years tax returns, to verify 2 years tax returns, we are going to ask them 2 years. One thing, there is another scenario. Let's suppose sometimes borrower has the wage income, like borrower is saying that they are wage earners. They are wage earners, right? Wage earner, and they have provided us pay stub, and they also provided us W2s. So wage earner, borrower, pay stub, W2 provided. But as documents, we always need tax returns. Tax returns from borrower, even they are wage earner, they need to provide tax returns. Now, the scenario is perfect. Borrower is earning sufficient income. Both the documents are in line. They are evidencing the correct income. We have verified everything is good. Borrower is able to qualify for the loan with this income. But when we go to tax returns, because we always need to go to the tax return, whatever whatever the borrower is, whether they are wage earner or self-employed, tax return always is going to be there. So when we are going through the tax return, we are just verifying whether all the things are in line, and we see borrower has a business income as well. Now, borrower did not disclose on the 1003 any information about the business, right? So as in the tax return, there is a business income. It could be any business income. It could be Schedule C, Schedule E, partnership, S corp, or maybe it could be a Schedule C, that is sole proprietor. So that kind of, but they have the business. Now what need to be done? Borrower is qualifying for the loan with pay stub and W2 income. When we are looking at the tax return, borrower has base a business income. What would you do? How you are going to treat that income? Do you need to consider that income in the loan or not? So that is what my question is. Tell me how you are going to, what you are going to do in that case. Yes. Okay. So yeah, almost you whatever you are telling, that is great. But there are two scenarios. One, even we are qualifying borrower as a wage earner, we are not checking as self-employed, but still we are going to calculate their business income, right? After calculating the business income, we need to see what is the outcome, right? What is how that income is being concluded. If it is appearing in the minus, sometimes there could be negative income, or let's say if positive income. As per the last 2 year tax returns, borrower is making $3,000 income per month, right? borrower is good to qualify income with wage earner W2, but he has additional income from the business as per the tax return, that is 3,000 income, right? But let's suppose what will if we come to know that tax return, like tax returns showing business income as minus $3,000 per month. It is in a negative figure, negative income. So it's a negative income. Then if remember, whenever we are going to check the tax return, if the income is positive from tax return, we can ignore this income and we can qualify borrower with wage earner and pay stub. If you want to write that borrower has positive income as per the tax return or positive business income as per the tax returns, but we are not qualifying, we are not including that income because it's a positive income, right? But if tax return showing business income as a negative, then we always going to consider that income in the loan. So we are going to include this 3,000 as a negative income in the loan, and even if after in the LOS, wherever the self-employment income could be or other income could be updated, you need to write that business income 3,000 minus 3,000, and it is going to consider that 3,000 as a negative income in the loan and going to adjust it with the positive income, right? Or the best thing is that instead of going doing it directly on the LOS, we can prepare the, as per your AUS, you can prepare 1084 form or you can prepare the LP. So there are two types of, there are two income analysis worksheets that is available online. You can go to any one of them, right? Especially if you are doing a Fannie Mae loan, that there is a 1084 income analysis worksheet, and if you are doing a Freddie Mac loan, then they have a form number 91, or in income calculator, that is 91 form, or 91, you can say 91 income analysis worksheet that you can download from internet and you can apply. We will go through both the forms, how to apply all the income in these forms, and it's the most easiest way to calculate self-employment income, because these both forms are self-explanatory, right? You do not need to worry for anything. We will go through both the form and we will go through all the schedules. We'll see how to we can calculate income with these, and then we can print these forms and can upload into the LOS. That is going to help other underwriters or whoever going to review those files after us. They can easily go through these income calculations, these income analysis that we have done and uploaded, and they can easily get to know what was our approach towards our underwriting analysis or underwriting calculations about the income. So what I am trying to say is, whenever there is negative income, then we need to consider. We can calculate wage earner income as well as negative income in this form, and whatever comes outcome, like maybe as per the wage earner income, borrower is making $10,000 per month, but when we included $3,000 as a negative, obviously the total income is going to be $7,000 per month, right? In this case, if borrower is qualifying with 7,000 income, then we are fine. If not, then that's a problem, and that loan we cannot approve that loan. We cannot exclude this income just to approve that loan, but we have to include. We can write in our comment, we can justify our comments why borrower is not qualifying, because there is a negative income appearing as per the calculations that we are going to show in these forms, either of them according to our AUS. If we are running LP, we can update form number 91. if we are running DU, we can update an income analysis worksheet, and that is how we are going to justify our calculation about the negative. That calculation part we are going to see how to calculate other income. I hope this scenario is one of very important scenario, and it has been now clarified. See what to identify, what to verify on the schedule 1 for other income, and how to calculate income from schedule C, schedule B, schedule D, schedule E, and all other schedules. Okay, so let's start or let's go to those.